Hello, this is Jesus Arce with Jack G Capital. You can follow me at Invest with Jesus A. I'm building a network of private money lenders. If you're at lending in the real estate space, I'd love to chat with you. If you're a real estate operator, I'd definitely help you out with access to funds. Today, we'll be going over our investment risk matrix. It's just an overview, so I'm going to go ahead and share my screen, and we'll get started with this presentation. So investment risk overview, we will be comparing five common asset classes. We will talk about assess risk, liquidity, return potential, and tax treatment. You can use this to support your strategic portfolio decisions. So we'll start off by talking about the different levels of risk and what that looks like. We'll start off with savings accounts, basically a bank account. The risk level tends to be very low, has high liquidity. Historic returns tend to be around 0.5 to 2%. The short time horizons and the tax treatment is that you are taxed on any interest that you earn. It's great to have emergency fund here. It's safe, it's accessible, but it does lose value over time. So you don't want to keep too much here. Obviously, if inflation is averaging 2% or more, then you're losing money, especially when you factor in that you've got to pay interest on any gains that you get here. The next category is permanent life insurance. The risk level tends to be below to moderate. Liquidity is very low. You can access the funds, but you have to take them out in the form of a loan. Historic returns here tend to be 3 to 6%. You can sometimes get higher rates for a shorter period of time, depending on the product that you're using. The time horizon is long term, and any gains that you have in your cash value are tax deferred. And obviously, you have a tax-free death benefit when that time comes. This asset class is good for legacy planning and asset protection. The next one I'll be talking about is the 401k. The 401k has a moderate risk level. The liquidity is low. There are usually tax penalties associated with taking money out of a 401k. Historically, you get returns between 5 and 10%. It's good, it's long term, it's for retirement. Any gains that you get there are tax deferred, which means that you do have to pay taxes when you retire or when you reach 59 and a half or more and you start taking distributions from your 401k, then you will be subject to regular income tax, and then subject to any market fluctuations and market risk, timing risk, and so on. The next asset class we'll talk about is stocks. Obviously, stocks can be very high risk level. Also, the liquidity is very high because it's basically you can sell the stock at any time. You do have historic returns that run between 7 and 15% on average. The time horizon tends to be medium to long term. The way it's treated for taxes is it is subject to capital gains tax, depending on how long you hold it, and then dividends, of course. This is a volatile, but historically, you get strong returns from it, and it does require active management, whether you're trading actively yourself or whether you're paying a financial professional to trade for you. The last category I'll be talking about today is real estate. Real estate is a moderate to high risk level. The liquidity tends to be low to medium. Historically, you'll get returns between 8 and 20%, depending on where you put your investment into, whether you're doing private money loans, maybe you're doing fix and flips, ground up construction, long-term rentals. It just depends on where you put your investment in. The time horizon tends to be medium to long term. Um, there are some, when you're thinking about taxes, you do have some depreciation benefits that can be used to offset income. And then obviously you have some capital gains there if you were to liquidate your real estate assets. Something to think about is that it is a tangible asset. It tends to be illiquid, but it's great for leverage, cash flow, and equity. So you're able to pull out equity, usually tax-free, if you pull it out in the form of a loan. Here's some key considerations for you to think about um, when building a solid investment strategy. You're going to think about diversification, liquidity versus return, tax implications, and then how real estate might work for you. So when you're thinking about diversification is essential. Each asset can play a different role in balancing your risk and return. When you think about liquidity versus return, so higher returns often come with lower liquidity and higher risk. Some tax implications for you to think about. A 401k and a permanent life insurance can offer tax advantages that can boost your return. Real estate can provide depreciation to offset taxable income. When you consider investments in real estate, they can be tailored to fit your strategy. You can have access to cash flow and tax-free access to long-term equity. So what are the next steps? So you can use this matrix to guide your portfolio allocation. You can consider your tax treatment and liquidity needs. You can tailor your asset mix to your financial goals and time horizon. And I would highly encourage you to meet with your financial or real estate professional advisors to help you make any decisions that you might have coming here in the future. I'd love to connect with you. If you'd like to schedule a discovery call with me, you can scan the QR code here and get my information. And then we can book a call. You can book a call on my website. You can also follow me at Invest with Jesus A. Appreciate your time today and hope that we can meet soon. Thank you.